No. Hola, hola. Hola, hola. Hola.
No, sí.
I cannot hear me. No? See? Okay. You can hear me. Okay, now yes. Okay, good morning. Thank you for coming. And moreover, thank you for inviting us. We are only lawyers, but believe it or not, in all this landscape of the startups and all the process of incorporation and divestment, lawyers are important, and maybe we can give you some tips about what is all this about. What is all this about is about pumping or injecting money, injecting funds in the company. I know that maybe some of you have experience and know all this, but let's give a step back to picture a little bit about the landscape that you will find, I would say, 99% of the startups that are here in the summit. So what do we have? What's the model of the startups? The model of the startup could be, well, it's been designed by a lawyer, it's very basic, but the, this is the model that we find. You have an idea, you incorporate the company, you create the company, and then you go in different stages of the company. PP, you know what is PP? PP, you know what is PP is? PowerPoint. I mean, I only have the idea, but nothing else. Then I incorporate the company, I have early stage, I have growth, I have expansion, and then the exit. What's the Spanish word for exit? How would you translate exit? Forrarse. It's, what this is all about is I want to make money when I make the divestment of my company. The divestment can be a sale to an institutional or a listing when your share are listed, and then you can buy and sell the shares anytime in the market. So in between, what you have is a landscape where different animals, different investors are going to coexist to live together in your company. And all of them, because of the nature of the business, this business, I mean, maybe you are lucky and this technology business generates cash and you have a positive EBITDA, but generally you don't. Or even you do it, you need to invest more and more and more to be the first one and get your vision. So at the end, you need pumping. You need to inject money in different stages. So typically you have the founders, personal money, a small amount of equity. Then you have friends and families, business angels, yes or not, seed capital, seed plus. You are around here, you are around the €1 million of investment. Then you have A series, B series, easy to remember, A, B, C, D, E, F, G, wherever, and then you have the listing and the exit. And this is what all this business is about. No, so where we're going to give you are some tips about different alternatives, different possibilities that you have when you have a startup to get those funds, to get that money from different kind of investors. I mean, just if anybody's interested, this is the same idea, but better drafted. I mean, this is in the public web of Newco. Newco is the own state Finnish company in Finland. They're in Helsinki. And, well, they created this, which is more or less the same when you have ideation, concepting, commitment, validation, scaling, and establishing. They have a very cool summit like this called Slash, which you know what means slash in English? Slash means aguanieve, which is what you'll find there. But it's pretty cool. Okay. You have different instruments. You have more sophisticated, less sophisticated. You may have an interaction between them. But I would say typically you have this. You have convertible notes. You have investment rounds, the series that you typically hear, A series, B series. And you have more recently venture debt also for a startup. And well, let's give you some tips. Let's begin with the convertible notes. Habla.
Hello. Hi. Okay, so convertible notes are a very simple financial instrument for startup financing. Um, when we talk about startup financing, the main transaction we usually look at are investment rounds, which are the most complex and complete transactions for startup financing. But there is a simpler way to get money, which is our convertible notes. Convertible notes don't necessarily come before an investment round because some companies that have already had an investment round, they also have convertible notes afterwards. The main advantage of convertible notes is that they are very easy to negotiate. There are simple transactions in which typically a venture capital fund or some other kind of investor will loan money to the company. This is just a loan that would have to be repaid, but since the loan is convertible in itself, the investor will typically be looking at a second stage in which the convertible loan will be converted into shares. So usually the convertible note is an anticipation of an investment round. And it's very fast and easy to negotiate because convertible loan agreements are very short, usually 10 or 15 pages. And you don't need to negotiate the main rights of the investors or the main terms and conditions of an investment round, which would typically take longer to negotiate.
Saying that it's very easy to negotiate a convertible note to get the funds. But if you put on the scale an investment agreement on I series that we will be commenting later on, and a convertible note, 3, 4, 5 pages, 10 pages, between 90, 100, 120 pages. So why is all this? We will be telling that, but I mean, maybe you can negotiate once you have the financial conditions. Maybe you can negotiate one instrument in days or in weeks. Okay.
In fact, there are several standardized models that the market has provided. For example, the SAFE agreement that was created by Y Combinator, and more recently the TAN agreement that is being used by the Venture City for its acceleration programs. So these models that are standard are already more or less prepared.
Is the I don't know if you know Y Combinator. It's probably the most famous accelerator in the world. They're from the US. They have a web page where they publish their, their standard agreement, so everybody can download it. And they created some years ago this SAFE, which is, the name is very graphic, simple agreement for future equity. I mean, we're raising a small amount of money comparatively to a series. We're raising 200K, 300K. So let's do things easy. I mean, let's try to do a simple agreement that will be converted in the following financing equity, and that's the reason. I mean, very recently, it's not so famous, but it's been done by clients, and they're also here, which are the Venture City, which is an accelerator, whereas the TAN, I mean, is the Venture City Association node, but it's because they are in Miami and they are all the time they're TAN, no? But you can also download it and check it.
And as we were saying before, a convertible note will require an additional stage, which is the conversion of the loan into shares, which in Spanish companies needs a shareholders meeting approving a share capital increase in order to create new shares for the investor.
You know, I'm thinking this is lawyers bullshit. I don't mind if this is board of directors, this is sole director, this is general shareholders meeting, but it's important that you know that in Spain, for a SL company, Sociedad de Responsabilidad Limitada, and the 100% of the companies that you have here are SL companies, you don't have a button and you don't have an automatic conversion where you convert your convertible note into shares like it happens in listed companies. You need a general shareholders meeting. So if you are founders and you are a member of the board of directors and you're going to execute this convertible note, my advice for liability reasons is that always you get the execution, the signature of all your shareholders, because they will have to vote in favor after for the conversion, okay?
So the main parts of a convertible note are basically the conversion scenarios, so when is the loan going to be converted into shares, and what will the conversion price be. Conversion scenarios typically are the next investment round, so when a venture capital fund runs these kind of loans, they are typically looking at converting simultaneously with the next investment round in the company. Also, sometimes you can agree to a liquidation event. This is when the company is sold, or all of the assets of the company are sold, the convertible lender will want to have the right to convert the loan prior to the liquidation event so that he can participate in the liquidation event. So for example, if there is an offer for the sale of 100% of the company and there is a convertible loan outstanding, the investor will want to have shares in order to be able to sell them in the liquidation event. And then there's a third scenario, which is not always agreed, but it's a maturity date. Sometimes you can agree that if 18 months have elapsed and there has been no investment round, then the loan will be automatically converted.
I mean, if we go to maturity, it's bad news. I mean, if we have the convertible, typically you don't request the money back for obvious reasons, because there's not going to be money to give you back. So typically, I mean, you can put whatever you want, but typically it's a obligation, it's a compulsory convertible note or mandatory convertible note. But if you are converting into shares without any of these events, are very bad news, because what you are betting is that you are putting the 300K, the 500K, whatever, and what you are expecting is that there will be a financing round, a bigger financing round with a bigger investor, you know, in 12 months, 6 months, whatever, before your maturity. So that's why Nico said before that it's easy to negotiate. Why? Because you just postpone the negotiation. You just hop on the conditions that the new investor is going to put on the company. You will be following wherever he gets. You will be converted in the most senior shares. So wherever the new investor gets, you will be following him with some requirements.
Yes, and then is the conversion price. The conversion price, typically it's the conversion price of the next investment round. So for example, when there is an investment round and the new lender, the new investor is having shares at 1,000 euros per share, the conversion loan will be converted into the same price. But sometimes, because the convertible lender is advancing you funds, sometimes in a situation where you need money to get faster, you can agree to a discount. So for instance, you can get a 20% discount on the conversion price, and sometimes a cap. For example, when you enter into a convertible loan, you don't know what the price of the next round is going to be. So maybe the price is very high, so you can agree to a cap. So you can say, my price will be the investment round price, and in any event, no greater than 1,000 euros per share, for example. So that will be the maximum. Sometimes the conversion price is agreed in advance in the convertible loan itself. So you already say, my price will be 1,000 euros per share, and that's fixed and you cannot change it. And sometimes this is very unusual, at least in Spain, we hardly ever see it. But sometimes in the convertible loan agreement, you have to guarantee a specific percentage of shares to the investor. So you say, I don't know how many shares will exist in the future, I don't know what the price will be, but you will get 6% of my company when you convert your loan. This is very rare, but we have seen it.
Yeah, I mean, you're not getting to the instrument. I mean, you're having a startup and you are receiving a term sheet or that draft of this agreement by an investor. I mean, you will see it, you will read it, but I would say 99% of the situation where you will have this is that a discount on the following round. It's easy. I get first, I get more risk because the company is less developed, and then when the investors come and the price per share is X, typically I will get a 20, 25, 15% discount over the price of the next round. This is the standard.
And then the other main thing about a convertible loan are the rights that have to be granted to the investor. As we said before, the main advantage of a convertible loan is that you don't have to negotiate these rights. So normally, you will grant the convertible lender the same rights as the lead investor in the next round. But sometimes, since you don't know if there's going to be an investment round, and as we said, there may be a conversion at maturity, some venture capital funds, they have a standard list of rights that they want to have, and they incorporate it as a schedule to the loan, and they say, this is the minimum of rights that I will have to have when I convert my loan into shares. And then you also need to grant the investor certain rights, very limited, before conversion. So for example, when a venture capital fund has given you money and they are not shareholders in your company yet, they need to have some rights like information rights. They need to have access to your financial accounts. They need to have access to your major investment decisions. And also some restrictive covenants. For instance, you can commit with a lender that you will not create a new company or you will not make major investments unless you priorly notify the investor and get its consent. Because the convertible lender has given you some money, he has to be able to be part of the decision before he has become a shareholder.
Okay. Well, if you have any question, please do it anytime. Uh, we got the convertible note any moment of the company, but typically at the very beginning because it's easiest and it's faster and gives you the opportunity then to move on and hop on to the condition on the investor. And these are the conditions of the investor. This is the A series, B series, C series, whatever. And what happened here?
So, hello, thank you for coming. Uh, Investment round is basically a share capital increase. A normal share capital increase implies the shareholders of the company investing more money in the company, pro rata to their stake in the company. The particularity here is that it's a negotiated share capital increase with third-party investors that are also existing shareholders of the company, but not all of them. So in an investment round, the equity structure will move because you will have dilution. And this dilution is the consequence of the money that is being injected in the company from other investors that are not shareholders in that moment in the company. So
let's
go ahead.
Let's speak about the term sheet. I mean, in the convertible note, you typically don't get a term sheet because you probably don't need a 5-page term sheet and then an agreement of 5 pages. But in an investment round, you always get a term sheet. And this is a huge difference between a venture capital transaction and a private equity transaction. In a private equity transaction, you may have or have not a term sheet. You many times end up going directly to the agreement, to the SPA, to the sale and purchase agreement. But in the venture capital transactions, you don't. Why? Because typically there is a disadvantage between the two parties. There is a professional investors and there is a founder. So, I mean, I call this the term sheet. Before receiving the term sheet, I typically say that love is in the air. Why love is in the air? Because you are a founder, you are looking for investor, you find an investor, you have a coffee with him or with her, you fell in love. I mean, I like your business, I like your venture capital, we can do things together. And that's all. Probably they will not speak about anything else but valuation and the things that they're going to do together. But what happened next? What happened next is the first reality bite of the transaction, and it's a term sheet. And the term sheet we will enter into the details, but the term sheet will include a lot of things and conditions that are legally binding and that are very relevant for the outcome of the future investor and the rights and obligations of the parties.
Yeah. So that's important because what you agreed on the term sheet normally will be reflected in the investment round contracts. So you have to be sure what you are agreeing on because that will be following you all around the investment round. So after the term sheet, typically the investors will carry out a due diligence. It's not an ordinary due diligence and a very long due diligence as in typical M&A.
I mean, probably all of you have a sense of due diligence. No? If I ask any of you, what's a due diligence? You may think or what you have in mind, but generally when we speak about corporate transaction and you think in due diligence, you think of
months.
Many lawyers, a lot of lawyers, young lawyers reviewing agreements overnight, tons of papers. And I would say this is not what this is about. If you are investing A series or a B series and you're putting 1 million, 3 million, of course you want to do a due diligence and you want that your lawyers make a due diligence, but you have to focus on which is important and you have to focus on the relevant aspects of a startup. Is it, is it relevant tax? Yes, it's relevant. Is it relevant labor? Yes, it's relevant. But so relevant to review hundreds of papers? Probably not. If the company is 2 years old, maybe they screw up with the taxes, but they didn't have the opportunity to make, a big claim for the tax authorities. Probably they did it wrong with the labor papers and everything putting in the right category. But if they have 5 employees, it doesn't make sense you enter to review all the contracts. But what happened with the IP? The IP is relevant. I mean, we may have a clean trace back of the IP. It's relevant to get there. What happens if the company is about big data? If the company is about big data, and I would say all the companies are about big data nowadays, and they did it wrong with the data protection rules, maybe they have a problem. No? The idea would be here, what we call is to avoid a skeleton in the wardrobe. A skeleton in the wardrobe. You open the wardrobe, there is a skeleton, there is no investment. No? This is the idea. I mean, so you try to focus to avoid these kind of things.
Mm-hmm. So in the due diligence, as Pedro said, you will spot the main contingencies of the business you are going to invest into, and that will be reflected then in the investment round contracts in order to protect that potential liability you have already anticipated during the due diligence. In terms of investment round contracts, there are 2, but they can be merged in one only document. And basically, the investment agreement is the part of the investment round in which you agreed on the conditions of the share capital increase, pre-money valuation, post-money valuation, dilution, etc. And the shareholders' agreement is the part of the agreement in which you set the terms and conditions that will regulate and govern your relationship once you have already completed the investment and you are a shareholder in the company, and you will have to live together with the other shareholders. So, next.
Well, just, I mean, we say, cada maestrillo tiene su librillo, no? So each lawyer has his own tactics. We prefer to have this on a single document, but some lawyers prefer to have it separate. This is all about liability. This is the liability that the investor is going to request to the shareholder or to the company if things go wrong. And this is about relationship. I mean, a company is like a marriage. It's about people coexisting and living together. So, liability and relationships.
So investment commitments by the investor. Okay, so this is the part of the investment agreement. As we were saying, is the part of the agreement in which you will set forth the money, basically, the economics of the transaction.
Fully diluted.
Yeah, I was going to say that most of these conditions will be already agreed in the term sheet. So,
I mean, we don't have time, and I think you have other showrooms with term sheet and conditions, other workshops. But I just wanted to stop indeed. Fully diluted is what I call loss in translation. It's very relevant that you read the term sheet and you get the proper advice. A typical mistake is to go to see the lawyer after executing the term sheet, because you say, yes, the term sheet is non-binding. Yeah, it's not binding, but then you have to sweat if you want to change any of these conditions with the investor. Okay? And a typically loss in translation clause is fully diluted. What means fully diluted? It means the following. If, for example, the investor said that he's going to request a 10% of the share capital of your company, but it is on a fully diluted basis, it means that he's going to request, or he's going to do for his or her calculation, that all the convertible notes and all the ESOPs, all the employee stock option and phantom shares are converted before he enters. So what it ends up is at the end, if you have convertible notes and stock option plans, he will end up, instead of having a 10%, having a 15 or a 16 or a higher percentage. So, I mean, it is not that they're cheating. They put it in the term sheet that they wanted fully diluted. And by the way, it's an absolutely standard practice, a fully diluted valuation. But you know, or you need to know what this word represents.
Yeah. And it also includes stock option plans or phantom shares. So even if they are not actually converted into equity, they will be factored into the equity post share capital increase. So you will be diluted not only in the amount of the new capital that is entering into the company, but also in that amount. So it's quite relevant. Um, yeah, conversion of prior financing and commitment.
Very quickly, representation and warranties. You may not be used to this, but basically it works this way. When you execute this agreement with the investor and you are a founder, the company or you personally will represent and warrant to the investor that everything is okay. That as of today, that you pay properly your tax liabilities, you did properly with your label obligations, you have the authorization that you need, you have the IP is yours, the data protection is okay, everything that you may think. And then later on, if something happens, for example, in 2 years, the prescription in Spain is for tax authorities. In 2 years, the tax administration comes and you get an inspection and you get a fine, you will have to give back part of the money to the investor. So I would say this is not right or wrong. It's just that you have the sense and the view and the understanding of you are executing, but this is for you a very relevant part of the term sheet and on the investment.
Yeah. Corporate governance of the company. So in the shareholders agreement, you will agree and regulate the conditions on how the company will be managed. So normally the company will have a board of directors as its governing body, and the investors putting the money in the investment round will request to have some seats on the board of directors, and also, even more important, some veto rights on the decisions to be passed at the board of directors level. So these are decisions as, for example, what strategy should the company follow, or who's going to be the CEO of the company. So the investors normally will push very hard to have a lot of influence and power on those decisions. So because at the end, with those decisions, even if you don't have the majority of the board, you can manage or influence a lot in the running of the business. We have to go fast, no? No, founders regime, very important, because most of the value of the startups are in their founders and in the human capital of the companies. So at the end, people putting money there don't want to have the relevant key employees leaving the company in the next day or in the next year. So they will ask for very hard conditions on their possibility to leave the company in the short term, or in their possibility to compete with the business or run another business, or which is normal.
You are a star. You get the idea. You founded the company and put in the money. So please don't go tomorrow to work with Google and leave us alone. No, is that? I mean, if we are going to put the money in a round, I mean, you have to stay here for a period of time, 2, 3, 4 years, and you will not be able to compete with the business of the company afterwards.
Okay. Then transfer of share regimes is the part of the agreement that will set further terms on how any of the existing shareholders in the company will be able to transfer the shares to another person. So these things, ROFR, ROFO, drag along, tag along, lockup, are provisions that all of them, what they do is they limit the transferability of the shares, because investors don't want to have the equity going out of the company. They prefer to have at least a word on that transferability to acquire those shares.
This is all designed, and in a sense, I mean, you need to get the balance between the different interests of the founders and the investors. But I mean, the venture capital funds, they have a fund. You know why they have a fund? Because they have LPs. They have people who put money in the funds, and the people who put money in the funds, what they're expecting is to get a return on the fund. So they try to organize or to have certain rights to make the exit, to be able to sell their shares, get the money, and pay to the LPs. It's as simple as that. And
economic provisions, well, liquidity preference is that in case the company goes bankrupt and you have to wind up the company, investors will have preference over the rest of shareholders to get their money back up to the amount that is still in the company in that moment. Anti-dilution is a provision that will protect the new investors of being diluted in future financing rounds. So they will have the the right to maintain their stake in the company in that moment if there is a new financing round. Distribution of dividends regime is just normally can be a lock-up provision to limit the distribution and venture debt.
We're running out of time. I mean, if any of you have any doubt or one more explanation about this, we could be speaking hours about this. We will be here and happy to speak with you. So venture debt. What do we have about venture debt, Nico?
Okay, so venture debt, can you hear me?
Blah, blah.
Venture debt is a very early market in Spain. It's not very developed. In the US and in the UK, there are several players that do this. But there are some players that, as Bridgepoint, Harbour, who are foreign and they do a lot of transactions in Spain, and also Inverredi, which is based in Barcelona. The thing about venture debt is basically a loan, but the financial conditions tend to be a little bit less favorable to the company than they would be in a convertible loan scenario. And well, typically the venture debt lender does not want to be a shareholder in the company, so the lender is just lending money. Sometimes they are looking at subscribing shares in the company, but only at their choice. For instance, in a convertible loan, you have an automatic conversion or almost automatic, so the lender giving you a convertible loan wants to be a shareholder, but in venture debt, typically it's just a regular sort of lending and financing like traditional banks with the possibility of becoming a shareholder. And the thing about venture debt is that usually they ask for a lot of guarantees. So what we have seen is a full security package of mortgages and pledges over the company's IPs, assets, and well, basically the IP.
What's venture debt in a sense? Is you are not getting an investment round, you're not getting a bridge, you're not getting a convertible note. And if you have a startup, it's very difficult that you get access to normal financing debt from banks. Because you don't have the kind of structure that you need for this money. So typically the companies that we see here in Spain is more mature in other markets, but it's like Bridgepoint, Harbour, they're not from here. Inverredi is a Spanish fund. What they want to do, in addition to the interest rate that we will charge you, I don't know if 10%, 20%, whatever, they want to participate in the share capital of the company. So basically you have two options, which is the equity kicker, that this sounds very well, very cool, but it's just that you have to give shares for free at nominal value. It's like comisión de apertura, but in shares, okay? And the second one would be the warrant, which is typically the one that Bridgepoint and Harvard includes in the term and condition. The warrant is an option, a pure option, to convert shares in the future at a high discount or a low price. So if things go right in the company will get the money back with the interest, so they get the loan back with the interest, and also they could convert that into shares at a very good price. I would say that. Come on, one question. Okay, thank you very much. If anyone has any question, we'll be around. Thank you.
Thank you.